Okay, wow, the Federal Reserve just cut interest rates by 50 basis points. What does that actually mean? What does that mean to mortgage rates? Did mortgage rates come down 50 basis points? My name is Beny Rabuchin. I'm a 20-year veteran of assisting homeowners and home buyers get mortgages that are custom to their needs. Now, there's a lot of confusion on what the Federal Reserve rate is and what mortgage rates are doing. And today I'm going to really dumb this down and simplify this so you understand the difference of the two, and more importantly, how this is going to impact you. Okay, so before I get into all the really good details on why this is going to impact you, I want you to understand the difference between the federal funds rate and mortgage rates. So the federal funds rate is the rate in which banks exchange money with each other. Some people call it the overnight rate. These would be your short-term loans. So debt that is directly tied to the federal funds rate are things like credit cards, auto loans, home equity lines of credit, or even personal or business loans. So the Federal Reserve rate is set by the Fed. What they're trying to do is manage our economy and control inflation. So if the Fed feels the economy is too hot, they will raise the federal funds rate, make things more expensive. If they feel like the economy is lacking, they will lower the federal funds rate to hopefully increase spending. So if the Fed feels our economy is too hot, they will raise the federal funds rate, make things more expensive. Look how much gas has cost us the last couple years. Look at your credit card rate. Those are averaging between 20 and 30% right now. So now that they feel that things are slowing down, now they're going to lower the federal funds rate to hopefully boost the economy. Okay, so let's talk about mortgage rates. Mortgage rates are tied to the bond market, more specifically treasury bonds. What we look at when we're monitoring mortgage rates is typically the 10-year treasury. So investors buy and sell bonds. When that is an attractive investment to them, we will see mortgage rates come down, but vice versa as well. Mortgage rates are also tied to just the broader economy. So the hot things for mortgage rates are inflation as well as the job market. So depending on what inflation is doing, depending on what our job market is doing, can drastically impact mortgage rates. All right, so the big difference between the two, remember, the federal funds rate are considered short-term loans. This is controlled by the Fed, where mortgage rates are tied to the broader economic economy and what the forecast is for our economy moving forward. These are considered long-term rates. Okay, so with that said, even though they differ, they are indirectly tied and do have some connection to each other. For example, if the Fed decides to raise the federal funds rate, that means they're trying to slow inflation. That also means that mortgage rates are probably going to go up because inflation has also increased. So it's not a direct connection. It's more about how the investors are going to react based on what the Fed is deciding to do with the economy. Now, lowering the federal funds rate could have the opposite effect, as it entices people to invest their money, which in return could result in mortgage rates also coming down. Now remember, mortgage rates are tied to other economic factors. The big ones are unemployment and inflation. When unemployment is rising, it's showing that the job market is starting to get impacted in a negative way, and we see inflation coming down. These two recipes that are happening are excellent for mortgage rates. Now, historically, we've seen that when the Fed decides to drop interest rates, at times we can see mortgage rates actually increase. So the opposite, as this can be seen as inflationary. But the reason why this time we're seeing mortgage rates come down as the Fed also drop rates is the Fed has been so restrictive for so long that it just had to break at the seams, and that's what we're seeing right now. Now, at this moment in time, inflation, which is something the Fed is keeping a really close eye on, is about 2.6%. Their goal is 2%. So for us, this could mean that we could see future federal rate cuts in the next coming months and years as they look to get that inflationary number down to 2%. And then we look at an unemployment, we're right at about 4.2%. If we get to 4.5% or more, which many of the markets are forecasting that we're going to see, this is going to be really good for mortgage rates continuing to go down. Now, in regards to the federal funds rate, while they did their first 50 basis point cut in September, we have 2 more meetings this year. And many are predicting that we will see 2 more rate cuts, probably 0.25% in the next one, and then the last one before the end of the year, another 0.25%. And then in 2025, many are forecasting that the Fed will cut another 1%. So we have a good 1.5% projected that will happen in the coming months and years. Okay, so let's get into why this is going to impact you as a potential homeowner. What does a 50 basis point cut on September 18th mean to you? Okay, now I want to show you something that is going to tie in all of this between the federal funds rate and mortgage rates. Now, the last time the Federal Reserve met before this September meeting was July 30th. And Jerome Powell, our federal chair, said, "If inflation moves down in line with expectation, growth remains reasonably strong, and the labor market remains consistent with its current condition. A rate cut could be on the table in September," he says. Okay, look at this chart from July 30th on what happened with the mortgage rate market as soon as he made that comment. You can see that based on his rhetoric, immediately we saw mortgage rates start to decline in a pretty big way. Now, as you can see, mortgage rates change every single day, sometimes multiple times a day. So you can see in this trend that we've seen some ups and downs. For the most part, the trend has been down, but the interest rate market is a lot more volatile. The Fed meets every 6 weeks. So if we were waiting for the Fed to meet every 6 weeks and mortgage rates were directly tied to that, that means mortgage rates would only change once every 6 weeks. So as you can see from these charts, mortgage rates move on a much different scale, and it's daily. Now here's another really interesting chart. So they cut their rate 50 basis points on September 18th. Take a look at this chart. It shows you what mortgage rates have done since they did that cut. And you're going to notice here that the trend has been up. I want to explain to you why mortgage rates have gone up since they did their cut on September 18th. So as we saw in that recent chart, last meeting was July 30th, and when he started to talk about that we're going to ready to start cutting rates, the markets that the mortgage rates are tied to, right, the treasury market, mortgage-backed securities, started reacting right away because investors saw this as a good sign. So what happened between July 30th and September 18th, which is about 6 weeks, mortgage rates already did their thing. They did a really nice drop since we saw on that chart. Once we got to September 18th and they decided to actually cut the federal funds rate, it had no effect on mortgage rates because mortgage rates had already done their thing. However, as you can see from this, mortgage rates have actually ticked up a little bit since they did their cut. Now, this isn't a sign that mortgage rates are going to continue to go up over time. But like we've talked about, it's very volatile depending on the economy and that day. So mortgage rates are going to see a bumpy road for the next several months and years. Now, there's going to be days where mortgage rates or weeks where mortgage rates go up. We're also going to have some good trends sometimes where they come down. Overall, what I would expect is mortgage rates to slowly tick down over the next couple years. So where are mortgage rates right now in September? Well, let's back up a little bit into time, back to November of 2023. We saw the peak of interest rates that we haven't seen that high in over 25 years. Rates for a 30-year fixed mortgage were about 8%. So where are we right now in September of 2024? Right now we are hovering in the low to mid sixes for a 30-year fixed. That is a massive drop from what happened several months ago. Now, many believe that as we are going to see mortgage rates slowly tick down, like we've talked about, there will be some good days and bad days, but they will trend down over the next coming months and years. Many believe that maybe in around 2 years from now, we land on an interest rate maybe in the high 4s or about 5% of a 30-year fix. Of course, this is only just projections of what will happen, but many economists feel that that's where we're going to land. Now, something to keep in mind as a potential homeowner, what does this mean to you if interest rates keep coming down? Now, we've had a lot of people on the fence for the past 2 years because we have had a serious affordability problem in the United States. It was just too expensive at these higher interest rates. The difference between your rent and what mortgage payments were so drastically different that many decided they're going to wait. So now that we see interest rates coming down, we're going to see a lot more people come off the fence and show some interest again in getting real estate. But what this means to you as a potential homeowner is now you're going to have more competition that you're going to be dealing with. So you have to keep in mind that while many people are hyper-focused on interest rates coming down and it being more affordable to them, this also means that home values are going to continue to increase. And the reason why that's going to happen is we have such a lack of inventory in the United States. While it's picked up a little bit in the past 6 months, it's still drastically lower than what the demand is. Okay, this is the difference between what happened in the Great Recession in 2007 and 8 versus now. Back then, it was the opposite. We had too much inventory. Builders had built for 5 or 6, 7 years, way too many homes. And because of that, there wasn't as much demand to fill up all that inventory. Since then, builders have been scared to build. So now over the past 12, 15 years, and all the millennials and all these new buyers coming back into the market, we have the opposite effect where we have too much demand and not enough inventory. This is going to result in home values increasing. Now, my best forecast to this is that we should see on a national average home values going up about 5% a year for the next coming years. All in all, with all this and the Fed starting to cut rates, this is great news for potential homeowners. And the reason for that is it's going to make it a little bit more palatable to allow you to get into the market to start owning some real estate. But here's my advice to you. Whether you think that you're going to be buying in the next weeks or months or maybe in 2 years from now, is to start the process early with the lender to get pre-approved. It's so important that you understand your numbers. It's so important that you get a plan that is specific to your financials and your goals in owning real estate. This is a very big investment that you're going to make in your life. Not preparing for that has a lot of risk. A home that will come on the market that one day will suit everything that you want could go away if you haven't properly planned and had all your ducks in a row. Having helped thousands of homeowners over the past 20 years get into home ownership, I'll tell you the ones that have the most success have a plan in place and started early like I talked about. If this is something that you are interested in doing and just dipping your feet in to understand where you stand and what you need to focus on, there's a link in my description that will allow you to start those steps with me. If you guys feel that this information I'm giving you is easy to understand and helpful in your journey of home ownership, guys, please like and subscribe. I will be updating you guys every single month on what's happening with the ever-changing market, as well as a ton of other education to keep you guys constantly informed. We'll talk to you soon.